Hi, this is Ryan with ourdebtfreelives.com. Today I'm going to go over what to look for in a mutual fund. So in our previous videos, we've gone through and shown you how to use the screeners to find a mutual fund. Now we're going to cover what you should be looking for in order to find a mutual fund that fits your needs. So this video is really meant for anyone who's just starting to invest or anybody who's wanting to take control of their own portfolio. So we're going to go ahead and get started.
So for my examples, I'm going to be using two different mutual funds. So the first one is Fidelity Select Technologies portfolio, and the symbol is FSPTX. And then over on the right, we have BlackRock Technology Opportunities, BGSAX. Like I said, they're fairly similar. So whether you're using Fidelity or Yahoo Finance, what you'll do is you'll just enter it like you would a normal quote. And here we have Fidelity. So over on the left, you can see that we have Fidelity Select Technology Portfolio. And this is the view that you'll see when you go to Fidelity and you type in the symbol. And then over to the right, we have Yahoo Finance. And we use the BlackRock Technology Opportunities. So you could use either one, but for this example, I'm going to be using Fidelity. But if you'll notice here, you can see that they both have the tabs on top. And if you go through on Yahoo Finance, you'll be able to find basically the same information. It may have a different name, but for the most part, the naming is going to be the same, but it may be on a different tab. So next, we're going to go ahead and start off with the summary. So when we look at the Fidelity website and we type in our quote, we'll get a page that looks just like this. And the first thing that you'll notice is we have the Morningstar snapshot. And this is just going to give you a quick overview of this mutual fund. So we have the overall rating, return, expense, and then risk on this category. And you'll notice with really any financial institution, they'll all use Morningstar for their ranking. So it's very common throughout the financial institutions. So we're going to start off by going to the details, and then you're going to click the More button over here. And so this is going to bring you to the fees and distributions. So we're going to talk about the expense and fees. And so we have the expense ratio that we're going to focus on, also the front end and back end load, and then the 12B1 charges, and then the minimum investments. One of the most important factors when you're deciding on which mutual fund to go with is actually the expense and fees associated with it. So I'm going to go ahead and run through the expenses. So we'll start with Fidelity first. So over here, you can see that there's an expense ratio, which is the gross amount, which is 75 basis points or 0.75%. And then the expense ratio, when we look at the net, it's also the 0.75. And that just means that there's no contractual expense waiver. Where if we look over here, you'll see that the contractual expense waiver is 25 basis points or 0.25%. One thing to call out about this is when you look at these, they're not a permanent thing and they can fluctuate. So if we look at this, the net expense ratio is 1.17%. And how they're coming up with that is they're taking the gross expense ratio and then they're applying the contractual expense waiver, which is basically something that the mutual funds do to try to lower the net expense. Now, when we come back over here, so when we look at the expense cap, this is basically just saying that this fund's expense ratio won't go above 1.15%. And then over here, we have 0% for distribution and or service fees. And this is the 12B-1 charges. And this is something that the SEC allows the fund managers to charge. And it's made up of such things as advertising to help promote their fund. And it's used to pay a commission to brokers that push the sale of this particular mutual fund. So for example, when we look at this one, BlackRock there's 25 basis points or 0.25%. Now what this means is if you have a financial advisor, they're most likely going to be pushing this one because there's going to be a commission associated with it. So that's one of the things to watch out for also. Now, when we look at loads, not all mutual funds are going to have these fees. And one of the things with Fidelity is on some of these funds, they actually waive the front end load or the back end load. So this is something that you'll have to go through and actually do a little bit of research in to see if your brokerage firm waives this fee. Now, if they don't, then you'll be stuck with paying this 5.25% front load fee. And so what this is, this basically is a commission. It's charged at the beginning when you purchase the fund. And you'll see that there's a schedule down here. So depending on your investment, your load fee may actually be different than the 5.25%. So now we have the expenses, and this is the total expenses per 1,000. So for the Fidelity Fund, you're looking at $7.50 up to $11.50. And again, the $11.50 is only if they were to increase the expense ratio. So they have that limit at 1.15. So it won't go above the $11.50. Over here, if we look at the BlackRock, you can see that it ranges from $14.20 up to $69.20. And this is assuming the contractual expense waiver is brought down to zero. So again, if you look at this, if you're investing $1,000, having 7% taken out is a big hit. So that load fee makes a huge difference as far as what your expenses are going to be. So again, this is going to be when you're looking at these funds, you'll want to take this into consideration. That load fee is something that you'll want to watch out for because it usually ranges between, I'd say 4 to 6, 7% is usually what you'll see on there. And next, moving on to the minimums. So you'll notice over here there's actually no minimum requirement. But when we look at the BlackRock fund, we can see the initial investment needs to be at least $2,500. And then also any additional investments that you want to add to it need to be in amounts greater than $250. And so this is another thing to take into consideration is some of these funds will have a minimum amount that's required to purchase this fund. And if it's something that you're just wanting to purchase a small amount or you're just getting started, and this is one of the things that you'll want to check. So you'll want to keep that in mind when you're looking at different mutual funds. So next we're going to look at the composition. So if you're on Fidelity, you'll want to go ahead and click the More. And so what we're going to cover on this one, we're going to cover market sectors, portfolio diversification, asset allocation, and holdings. So over here we have the sub-industry diversification. And then on this one, we have the major market sectors. So when you're looking at the market sectors, you'll be able to get a better understanding of where your mutual funds invested. So for example, when we look at this one, you'll see that the weighting is very high in technology. Had this been a target allocation fund, you would have seen a more evenly spread down here. Usually technology's higher up there in financial services. You would have seen it distributed between the different sectors. Next, we have the asset allocation. You can see here the Fidelity Fund is mostly domestic equities. And then when we go over to the BlackRock Fund, you'll see that domestic makes up 63%, and then it's got 30% in foreign stocks. So with asset allocation, it's very dependent upon your goal and what you're trying to achieve. So me personally, I have a lot more in foreign stocks than I do domestic. So here we have the asset allocation. So on the Fidelity Fund, you'll notice that the portfolio of this mutual fund is about 89% domestic equities. We're over here at 63%, and then another big portion of it is made up of foreign stock. So this allocation is important for me when I'm going through, and if I want to increase, let's say, for example, current allocation to include more foreign stock, then this fund would be a better option for me just based off the allocation. So next we have the companies that make up this mutual fund. And so over here, we can see that the top 10 holdings make up 52%, and there's 87 securities that make up this portfolio. Now, when we look at the BlackRock, we can see that the top 10 make up 30%, and there's 123 securities that are being held with this mutual fund. So one of the things you'll notice is this 30% is significantly lower than the 52 over here. When you look at Microsoft, the weighting, it's 4.76%. So if we look at this mutual fund, we can see the different securities and then the weighting over here. And for some reason, this one wasn't displaying the weighting on here. But if we looked at it, it's going to be significantly higher than these currently are. So if we look at, for example, Microsoft and Apple, these two are probably, Microsoft's probably going to be closer to like 10% in order to get to the 52%. So when you're looking at this, you can see that the diversification between these two funds, this is a lot less diversified, whereas the fund over here, it's a lot more diversified. So the amount is spread more evenly across the different securities, and there's also more securities that they're holding. So when you're looking at risk, if you have two similar mutual funds that, let's say they're holding the same companies, but the top 10 is, let's say, the 30% and then the 52, one of the things you'll notice is usually the risk associated with the fund that has the higher percentage for its top holdings is going to be a bit more risky since you're not as diversified. So next we're going to look at performance and risk. So if you go over here, click on the performance and risk. And so what we're going to cover in this one is the quarter end average annual total returns, the cumulative total returns, the volatility measures. We're going to focus on the beta, and then also historical fund performance. So when you see this over here, you'll have the expense ratio again showing up here. And then as we look at year 1, 3, 5, and 10, and then lifetime, depending on how long the fund's been around. So if you look at the inception date, that'll tell you how long the fund's been around. So for example, if the inception date had been 2012, we wouldn't have the 10-year, so this data just wouldn't be here. So the first thing you look at is you have the before taxes. So we have a comparison of this mutual fund right here, Fidelity Select Technology Portfolio. And then we have the S&P 500, which is a good gauge. It's an index that's composed of 500 different companies. And it's good to use as a benchmark. If you're comparing it to mutual funds, individual companies, you can see what the market's doing and then how this particular security is doing. And then here we have the MSCI IM Infotech, and this is similar to the S&P 500 in the sense that it is a weighted index, except it's going to focus on information technology. And then you have technology in general. And this one is going to most likely more represent your mutual fund. Same thing with this over here. Technology is kind of a bigger category. And over here we have after taxes on distributions, and this is after you go through and make a sell. Over here we have something just a little bit different. So you'll notice that this one has the load adjusted turnover here. So you can see what the return is after the load adjustment, which again is that fee that you pay in the very beginning for purchasing the mutual fund. And then we have these two benchmarks for technology. And so when we get down here, you'll notice that the returns, originally we have, 33.69%, and over here you have 25% return. And then by the time you get done with taxes and all the additional fees, you can see your returns down here. They're actually fairly similar. So that just goes to show you how big of an impact those expense fees can have on your returns at the end of the day. And so next you can look at the cumulative return. So down here you can see it for, again, the S&P 500, and then also technology. So you can see where the cumulative returns are. And this is going to be, again, short term. And the next thing we have is the volatility measures. And usually what I just focus in on is the beta. So if we look at the beta here, it's 1.33. So for example, if the market goes up 10%, this fund should go up about 13.3%. And then respectively, this one should increase by 11%. And then same being said if it goes down. So for this fund, you're going to expect a lot more fluctuation and volatility. This one should be more stable. So depending on what you're looking for, if you have a beta greater than 1, that means it's going to be more volatile than the market. And then if you have something less than 1, it's going to be less volatile, so you won't have quite the same movements. And then for historical fund performance, you can go through and you can look at what was the total returns and then also dividend payouts. And this is something that I'll look at, but I usually don't make any decisions based off of historical performance. So next we'll go on to ratings. You click on the ratings, we'll go over the Morningstar ratings. And so here we have the Morningstar rating. And this is kind of, you could view it as the gold standard for rating mutual funds and ETFs. All the financial institutions, when you go through and look up a mutual fund, you usually always see, no matter what financial institution you go to, whether it's Yahoo Finance, E-Trade, Fidelity, you'll see the Morningstar rating on mutual funds and ETFs. So it carries a bit of weight with it. So here we have the Morningstar rating. Now, one of the things to keep in mind is there needs to be at least 3 years of history. So if a fund was just created, they're not going to have a Morningstar rating yet. Now, the Morningstar rating is calculated based off of Morningstar risk-adjusted return, and it measures a few different factors, one of them being the performance compared to similar funds. And one thing to call out is the distribution of the stars. So one thing to take into consideration is there's only 10% of mutual funds and ETFs that have a 5-star rating. And if you look at the 3-star rating, again, you may say, oh, well, that's just average. But actually, it's about 67.5% of all mutual funds and ETFs fall under this category. So it's not necessarily a bad thing. The other thing to take into consideration is this is all based off of historical, so they may actually be improving. For example, if we look at BlackRock over here, you can see
over the last 10 years, they've had a 3. And then if we look at the 5 years, it's a 4. And then 3 years ago.
So that's one of the key things to keep in mind that we have right here. So past performance is no guarantee of future returns. So when you're going through and you're looking at mutual funds or ETFs, looking at just historical performance, again, is no indicator of what will happen in the future. That can be very misleading if you see some mutual funds with very high returns. So this is just a quick overview of some things to cover when you're deciding on which mutual fund to purchase. So I provided a link below that'll allow you to go to our website and view an outline of everything that we covered today. And I also go through and explain what I look for and why for each of these items. And thank you for watching our video. And if you do like, please subscribe. If you have any questions, please visit our website and you can submit questions there or in the comment section. And we will be posting additional videos that are targeted for anyone who's just starting out on investing. So please subscribe if you are, and you can stay tuned and you'll be updated of those new videos. Thank you.